Jacob, congratulations on the establishment of Antipodes. Obviously you were a senior member being Chief Investment Officer or Deputy Chief Investment Officer at Platinum, one of the key portfolio managers. So a great pedigree for the establishment of your own business. What is it that's different that you've brought to Antipodes as opposed to when you were at Platinum?
You know, I started before Platinum, has always operated in high conviction environments, and that's what we want to continue at Antipodes. So conviction, so portfolios that are constructed from between 30 to 50 key ideas. We think shorting is, buying stocks long is interesting, but as sector analysts, you're always looking for the winner and the loser. So we think we can add value by finding shorts that aren't just passive hedges, that drive returns. And ultimately, portfolio construction is at the centre of everything we do. And I think a real focus on team productivity, where the portfolio informs where you start and where you end. It's not an afterthought, sort of somehow disconnected from the process. I think those three aspects are probably the key points of differentiation. Not just, if you think about value strategies broadly, and we're competing against a lot of different managers, local and global. And I think they're points of differentiation across the peer group.
Jacob, you have the 3 unlisted funds, but are now also in the process of launching a listed investment company. What's the purpose of that, and does it mirror one of your existing strategies?
The LIC will be essentially just a replication of the the Antipodes Global Fund, which is the global long-short strategy with currency management. So exactly the same. Our motivation is to essentially, have a product that a fund that we can market into the self-managed super fund sector. That's a large, some 600 billion, I think, or more in savings in that area, and those investors typically invest in local shares, local property, very little exposure to global equities, and unlikely to invest into a trust structure because they just operate in the listed environment. And the LIC, I think, is the best product or best fund to sell into that market. And a managed ETF could be, an alternative. However, in our view, given our fund is truly global, it's a little harder to implement in a managed ETF structure. The LIC is a much simpler way of doing it.
Jacob, one of the benefits of establishing your own business is the ability to build your own team from the ground up. What's the structure of the team and the skill set and the background of the individuals that you've employed?
I think 9 is a great start. Look, we started with 200 million under management, and that's a large team relative to a small pool of capital. That capital is now expanding, and that's great because we have the capacity in the team to manage a significantly larger pot of investor money. The most important thing is that your team is working productively, and I think part of that is getting a sense of shared destiny, in the sense that if you can create a broad and tight alignment across the team with the end investor outcome, and hence, we offer most of our funds are offered with, a weighting towards performance fees with a lower base fee to purposely put the team's economics at risk.
This is a very large universe of thousands of companies. What are the characteristics that you're actually looking for, and how do you filter those companies that you're looking to invest in?
We're looking for the areas of neglect. Now, what does that mean? Look, we think you've got when great businesses start to be impacted by changes in the operating environment, and it's a continuum of different change. You've got extreme cyclicality through extreme structural change, and then that happens against a backdrop of socio and macroeconomic changes. And businesses can both benefit and suffer as a result of these changes. And our job as industry analysts is to understand when something is genuinely cheap, irrationally cheap, And then we look for multiple ways of winning, which is start with something cheap, but go beyond just valuation. For us, starting multiple and growth joined at the hip. You need to understand both sides of that equation, and there's no shortcuts. And our best investments have multiple ways of winning in the sense that they're resilient. If you look at 4 different factors that drive outcomes, often it's a product cycle, sometimes it's changes in the competitive dynamics. So in cyclical industries, after they go through a shakeout, assuming they're not being structurally disrupted, the leading companies will typically take market share and the weaker players will fall away. And so you do get a recovery in profits, and that's when often the business is most cheap. But competitive dynamics is also about new entrants, disruptors, at that point of mass adoption, when the market hasn't quite worked out how great a business it really is. And then finally, regulatory change and the impact that has on business. Now, if we find something that's benefiting from all 4 of these factors, then that's incredibly resilient. And that will typically be our largest position.
Jacob, you apply a high conviction approach, backing yours and your team's judgment in the selection of stocks for the portfolio. But what does that mean by way of the number of stocks that you hold in the portfolio?
So we set a guide of 30 to 50 stocks. And the reason we have that range is we think there's, as a stock picker, you will, essentially your job is to assess idiosyncratic stock risk and work out whether there is a genuine margin of safety if we don't get paid without purchasing risk. That's the business we're in, but we want to be compensated. But then there are the risks that you just can't control. And that's where we think we need a base level of diversification. So that's a minimum, say, 30 stocks. And then think about conviction and as a concept that goes beyond just the single stock. So we're trying to maximize risk-adjusted returns over the portfolio. So we talk about this as seeking non-correlated sources of alpha. We love to find clusters of opportunity that we can invest in multiple different securities in the portfolio. But to the extent that builds up a concentration of similarity, once we get to around 15%, we're starting to feel that we don't need any more. Because in a way, you're probably taking too much risk relative to return.